We are looking at NASDAQ BYND, Beyond Meat, and the numbers are telling a story of severe distress this morning. The market hasn't even officially opened, and in pre-market trading the stock is sitting at $1.22 per share. That is a staggering drop of 8.96%, wiping out almost a tenth of its already decimated value before the opening bell even rings, indicating a massive gap down from its previous close of $1.34. This isn't just random market noise or a reaction to a broad sector downturn. This is a direct, targeted, and brutal response to the company's third quarter 2025 earnings report, which was released after the market closed yesterday. The results have clearly spooked investors, and the selling pressure is immense. For a long time, the general expectation for Beyond Meat, a stock that once traded above $230, was one of cautious hope. The narrative investors clung to was that the company was a victim of inflation, that consumers would return to higher-priced plant-based options once their wallets recovered. The expectation was that management just needed to cut costs, stabilize the cash burn, and wait for the demand cycle to turn back in their favor. The reality, as laid bare by this new earnings report, is that the problem may not be the cycle. It may be the core demand itself. The bleeding hasn't been stopped, and the financial picture painted by these new figures is far worse than many had anticipated. Let's break down the numbers that are causing this pre-market collapse. The company reported third-quarter net revenues of $70.2 million. On the surface, this number actually slightly beat analyst estimates, which were hovering around $69 million. But that is where any semblance of good news ends, and it's a classic case of a headline beat masking a catastrophic underlying business failure. The real story is the loss. Beyond Meat posted a net loss of $110.7 million for the quarter, or $1.44 per share. This isn't just a miss, it's an explosion of red ink, dramatically wider than the $26.6 million loss they posted in the same quarter last year. The primary driver of this massive loss was a staggering $77.4 million non-cash impairment charge. The company essentially had to admit that some of its long-lived assets, its equipment and facilities, are not worth what they thought they were. This is a profound admission of operational failure and overexpansion. Furthermore, the adjusted earnings per share, which strips out items like that impairment charge, still came in at a loss of 47 cents, missing analyst expectations of a 43-cent loss. Volumes of products sold fell by 10.3% year over year. People are buying less of their product, period. U.S. retail sales, the core of their business, dropped 18.4%. U.S. food service sales plummeted 27.3%. The only, and I mean only, glimmer was a tiny 2.3% increase in international food service. But that was nowhere near enough to offset the collapse at home. But the final nail in the coffin, the one that is truly driving this 9% pre-market drop, was the guidance. Management projecting for the fourth quarter of the critical holiday season net revenues to be in the range of only $60 to $65 million. Wall Street was expecting forecasts closer to $71 million. This isn't a small miss. It's a signal that the business is deteriorating faster, not slower, as we head into the end of the year. This brings us to the short-selling activity, which has been a central theme for Beyond Meat for years. This stock is and remains heavily shorted. The latest data from mid-October shows short interest at a very high 14.51% of the entire float. That represents nearly 52 million shares being held short by institutions and traders who are betting on the price to fall further. What's more telling is the trend. At the end of September, the short interest was around 39 million shares. This means in just 2 weeks, short sellers piled in, adding another 13 million shares to their negative bets. They saw this earnings report coming, and they were right. Now, for retail investors, it's critical to understand what this data means. When you see a high short interest, the first thought for many, especially on forums like Reddit or X, is short squeeze. But a squeeze requires a catalyst and a high cost to borrow the shares. Right now, the data shows the borrow fee rate for BYND is incredibly low, around 2.7%. This means it is very cheap and easy for institutions to borrow shares to sell them short. There is no pain for the short sellers. They are not trapped, they are winning. The data also shows a days to cover of only 1.3. This metric tells you how many days of average trading volume it would take for all the shorts to buy back their shares. 1.3 days is incredibly low. It means they can exit their positions in just over a day. This is not the setup for a 2021-style squeeze. It is the setup of a high-conviction bearish thesis playing out. For those looking to protect themselves, it's important to know where to find this data. You can find official short interest reports on the NASDAQ website, and services like Fintel provide more granular data on borrow rates and fails to deliver. Speaking of fails to deliver, or FTDs, this is another red flag that has been flying. FTDs are when one party in a trade fails to deliver the shares on the settlement date. In late September, Beyond Meat saw a one-day FTD spike of a massive 8.7 million shares. While FTDs can happen for many reasons, a spike that large often suggests stress in the system, possibly related to naked short selling or significant institutional positioning. What's your take on that massive 8.7 million share fail to deliver spike? Do you see that as a clerical error or a sign of intense pressure on the stock's plumbing? Comment below. So, who is Beyond Meat? For those who missed the hype, this was the company that was supposed to change how we eat. Founded in 2009, it went public in 2019 in one of the most successful IPOs of that year. The stock was a rocket, built on the premise that its plant-based burgers, sausages, and chicken, made from pea protein and other plant inputs, were the future of food. They secured massive, high-profile partnerships with McDonald's to be the preferred supplier for the McPlant burger and a global strategic agreement with Yum! Brands, the owner of KFC, Pizza Hut, and Taco Bell. The expectation was that these deals would put Beyond Meat in every fast food restaurant on the planet, and revenues would be in the billions. The reality, however, has been a painful lesson. The McPlant trial was largely discontinued in the U.S. after failing to meet sales expectations. The KFC and Pizza Hut rollouts have been slow and limited. Consumers, it turns out, were curious but not converted. The products were criticized for being expensive, highly processed, and for many, simply not as good as the real thing. This backlash, combined with an inflationary environment where consumers are trading down to cheaper animal proteins, has created a perfect storm of collapsing demand. We saw a flicker of the old retail sentiment just last month in October, when the stock experienced a brief, violent rally. It became a meme stock for a few days, rallying on high volume as retail traders tried to ignite a squeeze. But as this earnings report proves, a rally built on sentiment cannot survive a collision with fundamental reality. The company is now bringing in turnaround specialists and announced another workforce reduction, signaling the deep-seated nature of its operational problems. The CEO, Ethan Brown, spoke on the earnings call, as he always does, with a sense of optimism, talking about strengthening the balance sheet and pursuing cost reductions, but the market is no longer listening to the words. It is only looking at the numbers. And the numbers show a company with a 160% negative operating margin, meaning it spends $1.60 for every $1 in sales just on its operations. Looking ahead, the path for Beyond Meat is incredibly narrow and fraught with risk. The company's future scenarios are bleak. The new guidance for Q4 implies a potential year-over-year revenue decline of over 18%. Analysts are going to be slashing their price targets this morning. The consensus sell rating on the stock is likely to become even more bearish. The immediate risk is the $1 mark. If the stock, currently at 1.22 pre-market, breaks below $1 and stays there for 30 consecutive days, it will receive a delisting warning from NASDAQ. That is a very real possibility. The only potential positive catalysts would be a sudden, unexpected new partnership or a complete operational and brand overhaul. But the company is burning cash at an alarming rate, and its ability to invest in the necessary marketing or research and development is shrinking by the day. This is the stark contrast between expectation and reality. The expectation, for years, was that Beyond Meat was a high-growth technology company that was just getting started. The reality is that it's a food company with a niche product facing crushing competition, falling demand, and a balance sheet that is deteriorating at an accelerating pace. This morning's pre-market action is not a dip to be bought. It is the sound of the market finally and fully absorbing the fact that the original bull thesis may be permanently broken.